Well, the stock market is in a bubble and it is set to burst. The stock market is booming, but really 7 companies are doing all the hard work. They're doing all the lifting. And these are the magnificent 7. It really reminds me of the dot-com crash, where the Wall Street was ignoring all the warning signs. But now because of AI, we're kind of like pushing along and say, oh, this is going to solve all our problem. But here's the twist. In 2000, we didn't have inflation, we didn't have tariffs, we didn't have crypto, and we were not on the verge of a recession. But now we do. So this is not just like an overvalued market, right? It's more like a fragile system where not everybody knows which direction this thing is going to go. And we have kind of a selective bubble that's tied to a bunch of economic landmines and political uncertainties. This video is your critical update on the tech-led market bubble that we are in. And in this video, I'll show you why I think this is a bubble, what signs to watch for, and also, more importantly, 3 moves you can do to position yourself for success across stocks, real estate, and crypto just before it pops. So the market, the economy, and the political landscape are changing rapidly. So these changes can dramatically affect your financial future. This is why it's so important to stay informed. That's why you want to click the like button and subscribe to this channel so that you stay on top of it all. So let's get started. So why are we in a bubble? The stock market isn't really like booming. So it is really the magnificent 7 that are pushing the market up based on AI technology. If I just look at the stock market today, it was up 12 points, but really only Google, Apple, and Tesla were in the green. The entire rest of the stock market of the S&P 500 were either at 0 or close to it or in the red. So only these 3 stocks actually push the market into positive territory. This is not a good sign. So during the dot-com crash, Wall Street was also pushing many startup IPOs because of the internet explosion. Wall Street ignored all the warning signs, all the fundamentals. They didn't care about profitability or anything like that. All they cared about was how many eyeballs you get. How many eyeballs? That was all about eyeballs. Today we have somewhat of a similar situation. Wall Street is pushing the magnificent 7 because of the promises of AI. The good things that a lot of these magnificent 7s are doing a ton of money. They're very profitable. We also have some AI startups that are not showing any profits yet, and they are able to raise billions of dollars. But here's the twist. In 2000, we didn't have inflation or tariffs, crypto, political uncertainties. We didn't have any of all of that, but now we do, and we have to factor that in. This is not also just an overvalued market. I see it more as a fragile market that's concentrated on a few stocks that are doing very well. They're very profitable, but a lot of these stocks are really betting on the AI. I mean, NVIDIA, Microsoft, Meta, Tesla with the robot. If that doesn't pan out, what's going to happen? So this is what I'm I want to make sure that we are aware of before we kind of go and dive in blindly like we did in other bubbles. Give me the warning signs to watch out for. So there are some hurdles in sight. Just like even the magnificent 7, not everything is that great. You just take Apple, for example. They're expecting in Q3 and Q4 to have about $2 billion in tariff costs that they didn't have before. Luckily, they have a ton of money, but they also have new products that are going to be released on September 9th. And then Apple is very consumer driven. How's the consumer feeling about the economy, about their job security, about inflation, about what's going to be the price of this Apple product? Are they going to say, you know what, I'm just going to wait a little bit before buying a new iPhone, a new iPad, or whatever? I'm going to wait to see, am I going to have my job in the next couple of months? Is the inflation going to go through the roof? So this is going to be something that's going to be very important to watch, and that's going to be only in a couple of weeks. Well, in a couple of months, we're going to start to see some results. Amazon, similar situation. The tariffs is impacting them, and the tariffs are kind of uncertain on what the prices are going to be. Also, it is very consumer driven. They don't really care about the products that are sold in there necessarily because they're just a marketplace, but it's very consumer driven. The more people are buying on Amazon, the better it is. And then we look at NVIDIA. So NVIDIA, their PE is very high. So the PE is about 50 price earning ratio compared to the S&P 500, which is around like 22, 23. And so it's double the price earning ratio. So that means that we expect NVIDIA to be twice as profitable as the rest of the S&P 500 together. But there's also some major trade tension with China, with the H2O chip that they want to, the sales of that. So there's a lot of issues around that, and it's not clear what's going to happen there. Google is doing great, but with AI, they have to redefine kind of like their Google search engine. How is the ads going to work? How is that going to work in their whole ecosystem? Is that going to affect their revenue? So there's a whole revenue angle that I think that's going to have to figure out, and how does that compare to to people using OpenAI and ChatGPT to search things, or DeepSeek. Tesla, the P is 198, so this is unbelievable. The sales are down globally for the Tesla, the car, their main focus. But they have a lot of distraction. So Elon Musk is one of the distractions, obviously, and he's distracted by all kinds of other projects, but potentially also about politics. Who knows what's going to happen? They also have a significant amount of Bitcoin, so they have exposure to crypto as well. And now the company is trying to pivot towards this Optimus robot, which is kind of like a humanoid kind of robot. Which, in my opinion, if you want a robot, you want robots that are specific to the tasks that you want to do. It doesn't make sense to have a humanoid-shaped robot, because then the humanoid robots, they're going to have like lower back pain. They're going to hit their toes on things and all of that. It's not going to be good. So basically, I'm not a big fan of that. I would prefer, if you're going to use robots, and we are using robots, industrial robots, and everything. Why do they have to be the shape of a human? Make them the shape that is very specific to their purpose. You don't have to look like humans in order to make it work or work better. The thing too is that Musk always under-delivers. Remember the full self-driving vehicle and stuff like that? Well, I waited like 6 years for that full self-driving mode, and it's still not there. I bought my first Tesla, and he said, oh, in 6 months it's going to be there. And then it was next year, and then 2 years from now. And then it's always so close. And then it's been like 6 years now, and still no full self-driving capability. You have to really constantly look at it, and it makes a lot of mistakes, trust me. Anyway, so any weakness could cause the bubble to burst at any time. This could drag the whole stock market down. So like we saw in the dot-com crash, because it was the internet stock that was kind of leading the way, when that collapsed, it brought the whole thing down. Everything went down. There was nowhere to take cover. I lost millions of dollars in that dot-com crash, and I'm speaking from experience here. I wish I had diversified in a different asset class. I had diversified. I had a full portfolio that was in many in hundreds of stocks, and it was all in the stock market. It should have been diversified outside, and this is what I'm going to talk about when I'm going to talk about the 3 moves that you need to make in order to protect yourselves there. So there's even more warning signs outside of the Magnificent Seven. You look at Caterpillar. They're saying that there's going to be like a cost for them this year of $2 billion that's going to be due to tariffs. Ford, they have another $1 billion that they say is going to impact costs from tariffs. GM, $2 billion from tariff-related costs. Then we have retailers like Walmart and Target. They're also under pressure on the retail side, the consumers buying this, but also all their imports, the additional costs for them to bring to bring the merchandise in and how much they can pass on to the consumer. So this is all going on, and this is just like a subset of the issues that I see. Q3, Q4 earnings, that's going to be critical. It's going to be something very important to see. And right now, I mean, we look at the Q2 warnings, they just look at, it seems to me like the stock market is just looking, Wall Street is just looking at what was the expected earnings per share, and then what did they achieve the earnings per share. And if they beat the earnings per share, that everything is good, no problem. But you need to read the fine print and really look at what the financial outlook that these companies are giving you. Caterpillar, Ford, GM, all these companies had warnings in their earnings calls to show that there was some issues here, and they were not out in the clear. A lot of the tariffs actually are affecting the input prices for manufacturing. So you make sure that you pay attention to the PPI. It ticked up last month. Is it going to continue to go up as we go along? That means that the input prices are also going to go up, and then when it gets to the consumer, there's going to be some decisions that are going to have to be made. We also have to figure out the tariff escalations, any kind of trade retaliation that we might get from the countries that we pissed off around the world. And then we have the dollar weakening. Dollar weakening, that means that when we go and buy things outside, like foreign goods or foreign input for our manufacturing, we have to pay more to get these goods. So that is a double whammy on input prices if you're a manufacturer. The companies are going to have to make some tough choices, and they're going to do three things. They're going to squeeze their margin, which means that the stock is going to go down. The price-earning ratio, their earnings are going to go down, so they're going to say, well, you're under pressure, you don't have pricing power, then your stock is going to go down. Layoff, that's also going to go into a situation where they're going to say, well, the stock is going to go down also on that, unless you're saying that you're laying off people because you're using some kind of technology to replace them. Then you're going to have the prices are going up, and inflation is going to go up, and that's going to affect your consumers. And you're going to also make sure that you have the pricing power that you need in order to raise the prices. So if you're Coke or Pepsi, you probably have some significant pricing power to raise the price of your product without affecting too much of your sales. So, and if just one or two of these like giant companies stumble on earnings, it's gonna, maybe at that point, I'm not sure, but maybe at that point, Wall Street is gonna wake up and say, we didn't think this was a problem, but now this seems to be a little problem. We have to pay attention now. Maybe that's gonna happen. One or a few of these giants, they're going to stumble, they're going to find something on the AI, maybe that's going to be, it's not going to happen in 6 months, it's going to happen in 10 years, or it's not profitable. So let's look at this article here. This is the big tech's market dominance stirs debate on concentration risk, because that's the big risk. Unprecedented level of concentration in a handful of tech stocks provokes strong feelings on Wall Street. So some investors fear the top heaviness means the bull run is on quicksand and will sink the minute an AI frenzy-fueled NVIDIA or Microsoft stumble. They make a mistake, or it's not profitable, or it's too costly, or whatever, or the technology is not going to be ready, or there's a massive roadblock. We can't get through that. For others, the worries are overblown. Gains have historically been powered by a small group of mega caps, and this is simply tech's latest time to shine. So this is top heavy tech stock, and you can see that if you add the Magnificent Seven here, they're over 30% of the S&P 500. That's why the stock market is going through the roof, is because these stocks are really going up and up and up. And as soon as they go down, you can see the effect also on the stock market dramatically. Scott Cornert, City Research Managing Director, the concentration is a badge of honor, well deserved for a group that continues to deliver unparalleled growth in sales and earnings. The five biggest, increased profit by 26% in the second quarter. This is great. Yeah, these are great companies. There's no doubt about it. But to him, valuations aren't stretched based on the profit forecast, but they have consistently been able to meet. So on a price earning to growth basis, no cause for alarms exists, which is the PEG thing. So the PEG ratio for the Mag 7 is not materially different than for the rest of the market. Valuation isn't an issue yet, so long as earnings growth expectations are met or beat. As long as you keep growing at the same rate, then we're going to be fine. But if not, then we're going to be in a big trouble. And I think there are a lot of signs where the growth is not going to be there. Maybe the earnings are going to be there, but maybe the growth is not going to be there because of all the things that we mentioned before. So there are reasons why the tech mega cap domination is likely to persist without incident. They generate vast amount of cash in good economic times and bad, making them growth and defensive plays at the same time. If you look at the PEG, you're also relying on the growth to be there also, not just the earning. I agree with you that, they generate lots of cash, lots of money. Page 1 in your finance textbook says that you should diversify your investments. And the reality is today that you're not diversified if you're invested in the S&P 500 because you have like 30% are in these 7 stocks, right? So this is the Apollo chief economist Thorsten Slok said. So NVIDIA has the biggest weight of any individual stock since data began in 1981, according to him. That's a risk that hedge funds have been taking steps to avoid, and this is according to Morgan Stanley. They did an analysis of all the filings from all the hedge funds, and they realized that among the investors, NVIDIA was the most under-owned large cap technology stock relative to its index weighing. So the firm says, so 2.41 percentage point, Microsoft was under-owned by 2 point. So they were making, these hedge funds were making adjustments to underweight these Magnificent Seven because they thought that the S&P 500 was too overweight. Okay. Emily Rowland, co-chief investment strategist at John Hancock. It is made up of a very high quality companies with little resemblance to 2000. They have strong earnings growth and balance sheet. But we recognize having a few stocks represent one of the largest asset classes in a portfolio is placing way too many eggs in one basket. So they're not too concerned that's going to be similar to 2000, but the instances when market dominance turned into a wipeout, most obviously during the dot-com meltdown, but also in the 60s and 70s. So that's from Steve Sosnick, chief strategist at Interactive Brokers. He recalls a nifty 50, a sainted few that could safely buy and hold forever, he said. Those included bulletproof names like Kodak, Polaroid, Kresge, J.C. Penney. You can go back also to the dot-com crash, things that you thought were like, names that would be there forever, and they're not there anymore. Leadership changes, especially in technology, indicating that many investors may be in store for more of these rotations, and then potentially some small cap stocks could actually move up into a prominent position. So the lesson is that technology marches on. So IBM was one of those stocks, and while it is around all-time highs, it has long been surpassed by the current tech winners. Intel was the semiconductor stock. So while PCs and AMD chips were just like considered a budget alternatives, and look at them now, it's a completely different pictures. So the Nasdaq 100 index rallied for 50 consecutive months in August. This is the tech-heavy benchmark's longest winning streak since March of 2024. So the market is bracing for what is known as the weakest months in U.S. shares as institutional investors rebalance, retail traders slow their buying, and volatility picks up. So this is kind of like September, October is really the slowest month. So lots of things going on. So this is why I think we really need to think about it. And I'm not saying get everything cash, take all your money out and whatnot, but I'm really thinking about make sure you diversify and make sure that you are, you're taking care of yourselves. So the 3 moves that you can do to position yourself the smart way and still be invested out there, take advantage of opportunities, but at the same time protect your money, protect your portfolio. There are, in terms of the stock market, I said don't chase the bubble. So don't go and try to buy and continue to buy. If you do, make sure that you have some stops and set some calls, sell some calls, and then really make sure that you take care of yourself, so that if the thing keeps crashing, at least you have a stop that you're able to capitalize on. You keep riding it on, but then sell some calls to make sure you're there. Or buy some puts. I would avoid the small caps. They're probably going to be the ones that are going to be the most affected by tariffs, by inflation, by consumer. So I would stay with the larger cap things that are. It's going to be a little bit safer. The returns are probably not going to be as high, but at least it's going to be some sense of protection for your assets, for your equity. The next thing is crypto. So a lot of people are going to go and try to move to crypto and say, oh, it's going to be safer, and it's like the digital gold and whatnot. The thing is that crypto, as I mentioned earlier in another video, is that it's correlated with the stock market. So if the stock market goes down, Bitcoin is going to go down. If the stock market goes up, Bitcoin is going to go up. And it kind of amplifies or exaggerates the movement that you see in the stock market. So this is good to know. That means that if you think that the thing is going to go up, it's good to be in Bitcoin, because then it's going to go up by more, like 2 or 3 times faster than what you see in the stock market. So take advantage of that. So these exaggerated changes. But also, don't go full out on Bitcoin and ETH to do that and try to take advantage or take a shortcut. The next big thing is real estate. So my favorite is cash flowing rental properties. If you want to do like turnkey rental properties, you can check out Martel Turnkey. This is one of my company. If you want to invest in apartment buildings and multifamily in a syndication, so both of these are very passive kind of investment. You just set it and forget it. So for the multifamily, you could look at Red Brick Equity. For the turnkey single family rentals, you can look at Martel Turnkey. If you don't know what the strategy should be in real estate and you want to book a call with me, I'm going to put a link in the description for this video. You can download my investor game plan starter kit, and then you can also book a call with me and we can discuss kind of like where I think what you should be doing there. So these are the 3 moves: in stocks, in crypto, in real estate. So I hope you found this video helpful and kind of give you a perspective or a fresh perspective on what the stock market is about to do. And don't forget the 3 big moves that you should be considering when you're looking at your portfolio. I continue to monitor the situation in these markets on a regular basis, and I try to always look at a different point of view and different perspectives to make sure that we take advantage of opportunities but also stay protected. So on your side, make sure you stay informed, make sure you like this video and share it with someone that needs to hear this, and also subscribe to this channel so you don't miss out on the next video. And see you next time.